Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China FEIHE Limited annual report. China FEIHE Limited is a diversified investment holding company that operates in multiple segments to provide various products and services to its customers. The company's primary business involves producing and selling dairy products, including instant milk formula, adult milk powders, liquid milk products, soybean powder, and rice powder supplement products. Under the dairy products segment, China FEIHE offers a range of brands such as Super Premium Astra Baby Atwo, Super Premium Organic Genjai, and others. The company also operates in the raw milk segment, which involves collecting and processing raw milk for sale to dairy product manufacturers. In addition to its core business, China FEIHE Limited provides nutritional supplements products, including vitamins, minerals, herbs, and other health care products. These products are sold through various channels, including distributors, retailers, e-commerce platforms, and direct sales to end consumers. The company's extensive range of products and services cater to the needs of customers in mainland China, Canada, and the United States, making it a significant player in the dairy industry globally. China FEIHE Limited market capitalization of $32 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that China FEIHE Limited holds a significant advantage in their industry. China FEIHE Limited trades at a lower price-to-earnings ratio of 11 times and a higher price-to-book ratio of 1.25 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The balance sheet appears very conservative, with liabilities representing only 23% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The company have a dividend yield of 6.79%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. On the positive side, sales to external customers have been a significant driver of revenue growth, with notable increases in the dairy products segment and nutritional supplements segment. Geographical markets have also contributed to revenue growth, particularly in China, where consumers' confidence in infant milk formula products has led to increased demand. Government policies such as the childcare subsidy system and free preschool education policy have also had a positive impact on revenue growth by increasing demand for childcare services and related products. Additionally, e-commerce sales in China among younger generations of consumers have driven revenue growth. On the other hand, revenue decline can be attributed to several factors. Sales to external customers have declined in certain segments, including raw milk products and nutritional supplements. Geographical markets have also experienced declines, particularly in China and the USA. The cost of sales has increased, while breeding costs and production costs for raw milk have decreased. Other drivers that have impacted revenue growth or decline include changes in depreciation of property, plant and equipment, employee benefit expense, write-down of inventories to net realizable value, and impairment of trade and other receivables, net. The financial performance of a company has undergone significant changes between 2024 and 2025. A notable decline in net income is observed, with a decrease of 14.5%. This reduction in profitability can be attributed to various factors, although the exact reasons are not specified. A closer examination of the profit margins reveals that gross profit margin has also experienced a slight downturn. The margin decreased from 66.3% in 2024 to 65% in 2025. While this change may seem minor, it still indicates a shift in the company's financial performance. The company's financial performance indicates a strong ability to generate operating cash flow. According to the data provided, the company generated $234,219 from operations in 2025. Furthermore, its total operating cash flow for the same year was $213.8 million. This significant amount of cash flow is a positive indicator of the company's financial health and ability to sustain its business operations. The company's debt level and interest expenses have undergone significant changes over the past year. A notable decrease in interest-bearing bank borrowings by 66% from RMB 485,054 to RMB 165,450 indicates a reduction in short-term debt obligations. Conversely, long-term bank deposits increased by 16.7%, suggesting an increase in long-term financing. In terms of interest expenses, finance costs decreased by 28.8% from RMB 44.6 million in 2024 to RMB 31.8 million in 2025. This reduction in interest expenses is likely a result of the decrease in short-term debt obligations and potentially lower interest rates on long-term bank deposits. Overall, these changes suggest that the company has successfully managed its debt levels and interest expenses over the past year. The performance of various segments in the company's revenue can be summarized as follows. The dairy products and nutritional supplements products segment was a standout performer, generating significant revenue for the company. Within this segment, the dairy products segment specifically performed exceptionally well, with a segment revenue of RMB 20,733,604 and segment results of RMB 3,005,048 and RMB 5,026,855. On the other hand, the nutritional supplements segment struggled, experiencing a negative impact from intersegment sales. This had a significant effect on the company's overall performance, highlighting an area that requires improvement. Overall, while some segments excelled in terms of revenue generation, others faced challenges that need to be addressed for future growth and success. Management's outlook and strategy. The company's management has provided insight into their outlook and strategy, highlighting several key points. Firstly, they intend to consider hedging significant foreign currency exposures, indicating a proactive approach to managing financial risks. This move suggests that the company is committed to mitigating potential losses and maintaining stability in its operations. In terms of growth and expansion, management has stated that they have no specific plans for major investments or acquisitions at present. However, this does not mean that the company will remain static. Instead, it implies a willingness to identify new opportunities for business development as they arise. This approach allows the company to remain agile and responsive to changing market conditions. Furthermore, management has reaffirmed their commitment to shareholders by maintaining a dividend policy of distributing at least 30% of total net profit each year. This demonstrates a focus on returning value to investors while also ensuring that the company remains financially sustainable. Overall, these statements provide a clear indication of the company's priorities and direction for the future. Concerns about inventory buildup or supply chain disruption exist. There are indications that a company may be facing challenges related to inventory buildup or supply chain disruption. The decrease in the cost of sales as a percentage of revenue from 2024 to 2025 is a notable trend, suggesting potential issues with inventory management or supply chain efficiency. Furthermore, the declining gross profit margin and overall gross profit also points to potential problems with cost control or efficiency. This could be related to inventory buildup, where excess stock is tying up capital and not generating sufficient revenue, or supply chain disruptions, which can lead to delays and increased costs. These concerns warrant further investigation to determine their root cause and impact on the company's operations. That concludes the financial summary for China FEIHE Limited. Feel free to comment below, and I will be happy to answer them when possible.